Hey traders, this is Blake Morrow with Trader Summit, and I have Mr. Jim Welsh. It must be Friday, right after non-farm. Welcome back, Mr. Welsh. I missed you the last 2 weeks.
Well, welcome back to you, Blake, as well. I missed you.
Well, thank you. Well, hey,
Oh,
let's.
bro.
I know this is a little bromance. You guys have to stick around because don't worry, we're going to get into it. Actually, let's get into the thick of it. Good jobs report. Well, I mean, we missed expectations, the headline number just by a little bit, but average hourly earnings ticked up and the market doesn't care. The market just says, oh, wait, inflationary pressures are still there. Who cares? Market's going to rally. What's up with that, Jim?
Well, I think the market wants to believe that we're going to get a soft landing, that we're going to avoid a recession. So a modest deceleration in job growth. This is the first time the actual number came in under expectations. It's the first time in 15 months. But at 209,000, it's still twice what you need to absorb the growth in population. And Powell has referenced that, 100,000. So I think you need more than just, we came in a little lighter than expected. And wage growth, again, buttresses the idea that we're not going to have a recession. And that, in my mind, Blake, is the key behind how the market's been able to perform. And as you know, I didn't think we were going to have a recession last year. I thought the first half of this year was going to be okay. And, that ran counter to, a lot of economists who cried wolf all last year or from mid-year on, recession, when it didn't happen. Oh, well, it's going to happen now in the first part of this year. And I just think people just tuned out the idea of a recession because, they thought that was going to happen. It didn't. And I think what they're overlooking, and you and I have talked about this many times, is the lag time. You get these signals from various economic indicators like the yield curve.
Yeah, yield curve's been inverted for how long now?
July of last year is when it inverted. So a lot of people, oh my God, we have an inversion. And they read somewhere where, gosh, an inverted yield curve has predicted every recession for the last 50, 60 years. And they're on board for the recession camp last year. Well, there's kind of like a footnote. The footnote being that the average lead time in the last 50, 60 years from a point in time of an inversion to a recession is 19 months. So it is, and that's one of the reasons why, to me, it's okay. And I even talked about this last year. All right, it's inverted, but it's not the indicator I prefer. I like leading economic index, which has an average lead time of 10 months. When did that turn negative? November. So my point being is a lot of people cried wolf regarding the recession. And now, it's like teenagers. You talk to them and you've had the same conversation numerous times. And you can just see in their eyes, they aren't listening anymore.
Wait, have you been in my house recently?
I had two teenagers, and I remember, trying to have this very thoughtful conversation. And all of a sudden, I can see the attention span gone, and I'm giving them such sage advice, and they don't care. And I think that's what's happened here with the market in terms of, hey, recession, I don't want, it ain't going to happen.
Yeah. Well, okay. So, you're saying average of 19 months from the yield curve inversion. That was 9-10 months ago. We could really be another year. Let's think about that. Let me grab my abacus.
Yeah.
Somewhere.
You have fingers,
Yeah, I got it. That's right. Okay.
12 months, so you can count both ears for 11 and 12. No, I think the thing that to me is important, and again, is misunderstood, is the increase in lending standards. They ramped up significantly. This is another very reliable recession indicator. Whenever lending standards, or more than 20% of banks have increased lending standards, a recession follows. But again, it takes time. And it got up to 46% in the first quarter. So what happens in the real world is I'm a small business guy. My loan comes due in October. So the banks raised lending standards last year, but hey, I don't even know that's a reality until my loan comes due. So the impact and drag on economic growth it doesn't like an on-off switch. Okay, everything's going to turn off. No, it's progressive, gradual over a period of time. And I just think a lot of things are coming together as we get later in the third quarter, just based on the lead times on these things, that we're going to see more pronounced slowing. And I think the labor market is starting to tip it off. We see hours worked, they did tick up from 34.3 to 34.4. I didn't think that was just going to, drop out of, through the basement, if you will. It all takes time. So again, my take is that there's a gap in that window. And right now, Wall Street is basically of the mind that if it hasn't happened by now, it's not going to happen.
It ain't going to happen. Right. Okay. Well, let's start off with some of these charts that you brought before we get into your response about market reaction and your technical picture of how you are seeing things. And by the way, if you all, and I actually had people asking on my daily shows for Forex Analytics, asking me, hey, are you having an interview with Jim Welsh today? So I know people have been waiting. If you have, and you've been waiting for this interview, make sure you give Jim a big thumbs up. Jump in the comments down below if you have any comments for him. I'm sure he'd want to hear from you, and make sure you check out Macro Tides along the way. So Jim, let's get into your first chart here, which has to do with labor market weakness coming. That's the headline here. Tell me what we should be looking at and expecting from here.
Okay, this chart I had, and you and I actually had this chart 2 weeks ago. I had it in the July Macro Tides. And one of the things I'll touch on is gross domestic income. And I can't remember how much we talked about that. But gross domestic income is just as important as GDP. And in the the fourth quarter of last year and the first quarter of this year, gross domestic income was negative. So again, it's all showing signs of deterioration. So all this chart does, and I think it's important, is it looks at the change in the Fed funds rate. They moved it forward by 18 months. In other words, there's a lag time. We know, we just talked about the yield curve is 19 months. These guys moved this forward by 18 months. And then what does the correlation with the unemployment claims? How does that look? And it looks pretty tight. And what it implies is we're about to see an increase in unemployment claims building sometime over the next handful of months, really. I think it projected, the Fed fund rate was first increased in March of last year. You take 18 months and you're September of this year. It's coming. What the next chart shows is unemployment claims. Since this is the chart, okay? So here's what we can look at. All right. The zero line is basically the average of unemployment claims for 2018, 19, and last year, 2022. And now let's compare the numbers so far this year with the average from those 3 years. And what we can see is in March, right around week 8, 9, it started to move above the average of those other years. And we're holding there. So, again, this is telling me that the expected slowdown in the labor market is starting to develop. The key point is in the July Macro Tides, I had a chart also of continuing unemployment claims. So, what happens near the end of a business cycle, you start to get a tick up in unemployment claims, but the labor market is still strong enough so that somebody gets laid off and they get a new job in 2-3 months. At some point in time, the increase in unemployment claims gets to be so high, and I think we will see sometime between now and year end, unemployment claims, we're going to have a weekly number above 300,000. So at some point in time, the increase in unemployment claims exceeds the economy's ability to absorb those who are unemployed. And that's when you see the continuing claims start to rise. So the first part of this process has begun. Now it's just a question of monitoring continuing claims and see what they're doing. And they're always a week behind the way they do the calculation, the unemployment claims. But I think we're going to see that happen, Blake, and that'll be, again, another confirmation that the labor market is beginning to soften. And obviously that's important because someone who loses their job isn't going to spend as much as when they were working. But this takes time. The labor market is the last thing to go. I think, the majority of economic indicators are pointing in that direction. Now it's just a question to see, when does it happen? I think it will happen between now and year end.
All right. Well, the next chart you bring, Jim, is actually CPI, and today's labor data. The average hourly wages came in stronger than expected. Is that gonna affect CPI moving forward? And there are two camps. I think there's two distinct camps from the people that I've talked to, the people that I've listened to. I've listened to a lot of podcasts. And people that you're either in the deflation camp or you're in the sticky inflation camp. What do you think?
Well, just look at this chart. Again, understanding, and just let me back up. I mean, last October, you and I talked about there was going to be a big decline in the CPI inflation, primarily because the takeaway values from late last year were so big through the first part of this year. And the biggest one of this year is June of last year. It was 1.32, and I have this marked wrong. It should say June 22, May 22. The headline is right. Okay. So we're going to subtract 1.32% off the inflation. Well, what are we going to add? If we add 0.3, that means the CPI will drop by 1%. Well, it was 4% in May. So my point being is I can see it coming in between 2.9 and 3.2%. Just depends on how much inflation we had in June of 2023. So that's a big point. So will markets embrace that? Yep. Between the softer jobs number, CPI coming down, I think the markets are going to react positively to that. But going forward, so the next 6 months, or let me back up. The first 6 months away this year, Blake, the average takeaway was 89 basis points. The average takeaway between July and December is 20. So in other words, the hurdle rate drops significantly. And in July was actually flat a year ago. And what that implies is that, if you just get if we average more than 0.2% in the next 6 months on CPI from July to December, the CPI headline is going to go up. So I don't know if that's going to happen or not. It depends on a lot of things like energy prices. Do they rebound and so forth? But my point is we've seen this huge drop and look at inflation is really coming down. And then we're going to see, I think, headline CPI kind of flatline and maybe trend gently upward for the balance of this year. Core takeaway, you can see that core takeaway values are bigger, and the shelter component is going to start to soften. It already has. It's going to soften more. There's a lag time in the shelter. The way they calculate shelter CPI, there's a lag time. And we've seen rents come down. Housing prices have softened. We're about to catch up to what happened over the last 12 months. My point being is the huge progress on a headline inflation after this next report coming out next week on June CPI is going to disappear. And again, to your point, you've mentioned it several times, wage growth up 0.4. I mean, I think it's flatlined right around 4.5, 4.6 annually. Well, that's not, commensurate with a 2% CPI or 2% inflation, which is the Fed's target.
Yeah.
The other thing, again, I think people just don't understand this. The Fed isn't going to back away from, so in my mind, yes, are they going to raise in July? Absolutely. But they're going to maintain rates for a really at a high level for a real long time, Blake. They really want to see the unemployment rate tick up. And as I've written, and I think we've talked about it, the projection from the last meeting was unemployment rate of 4.5% next year. That's telling us that for them to really feel confident that inflation is going to continue to trend down in coming months toward their target, you're going to need to see an unemployment rate above 4%, and in their minds, 4.5%. So none of these numbers, the better CPI, the softer jobs number, they're not going to dissuade the Fed from increasing the funds rate in July. And, again, my point is the drag from all these rate increases, I think will start to really show up in the last 6 months of this year. And then they're not going to cut rates quickly.
So that, I mean, the likely response from you is Fed's going to keep rates. They're going to raise rates in July. They're going to keep rates high. Market still seems to be coping with it okay because we are at this point skirting the recession and
Yep.
maybe have no landing or soft landing. But I'm wanting to see what your chart suggests moving forward. So let's go ahead and go through into the dollar. And the dollar, got hit today, as you know. We have the euro back nearing 110. We have the dollar index slipping, and what I like, what I've been referencing as a triangle consolidation. Even though I'm just kind of drawing it on your charts, I'll just kind of do that. But where do you see us going from here? Because it is a bearish consolidation. We're consolidating near these lows,
right? And that's the triangle pattern would imply that once we finish it, wave E. Now the thing about triangles, they're really kind of annoying because they can go on and then they can go on. And so it's possible that from that low we saw right above the D, and then I have the wave E. Well, it's possible that bounce was wave A of E, this pullback is B of E, and then you get another little rally. I mean, so it's just annoying how they stretch out.
Yeah.
But to your point, it's a consolidation after a rather large decline. And what it implies is that we're going to see the dollar go to new lows. And today's reaction again of, oh my God, softer jobs number, that's going to have an influence on Fed policy. No, it's not. It's not. But yet the markets are reacting that way because I think a lot of folks just don't fully understand where the Fed is at, and they don't want to listen to what the Fed has been telling us.
Well, I think that the dollar is going to be a multifaceted function, but a lot against yields. And we're going to go into your charts in the bond market here in just a moment. So let's move along, and let's get into your next chart, which you have brought gold. Gold consolidation as well, struggling to get below 1900. So is this that pullback? I know you've been looking for like 1850. For a place to be long somewhere down here, 1880 to 1850. My memory serves me correct. But is this enough? I mean, is this enough?
I guess I don't think so quite yet. The 382, I've shown that number for weeks and weeks that, okay, the 382 is around 1890. Last week, the gold dropped to 1894. I think you can get a bounce. But I don't, again, the dollar is in this range. And until it breaks out of that range, either above 104 or below 100.75 or whatever the number is, it's kind of like it's in no man's land. What kind of gold is then dependent on that? If the dollar does indeed break down below 100, hey, gold's going to get a pop. I still kind of feel, Blake, that people are misreading the Fed. We're going to continue to hear speeches by the Fed, the majority of them. And here's the point. 12 out of the 18 people on the Fed at the last meeting were in favor of raising the funds rate twice. So they're going to have to see really strong data points to convince them that isn't the right course of action. So, until the dollar actually breaks down, it's just sideways. And the gold, I think, can get a bounce, a little bit overdone. Obviously, you can look at the RSI, got comfortably below 40. Yeah. So a bounce. Can it rally back up towards 1950 or so? Yeah. Does that tell us that we're beginning the next wave up? I'm not confident. I still think there's a chance you get a bounce here, and then there's another drop coming below the recent low. So that's my take.
Well, let me go into the next chart, because this is going to be maybe more of a determining factor. What happens to gold is what happens in TLT, because now you were looking for a move lower in TLT and then a reversal higher. You a while back, you were thinking we were going to go rally, but you're like, if this breaks, we're going to come down and then bounce. So are you still in that camp?
For the most part, yes. But at the same time, I'm a little bit more cautious in the short term, Blake.
Yeah.
We took out that trend line. I thought TLT was going to have a drop. I had been saying, hey, buy it at 99.20, which would have obviously gotten triggered this morning. I'm just not convinced that rates are done. The 2-year popped above 5, then it's come down below. Again, I just think the Fed is, they're looking to raise rates more. And until we see definitive signs that the economy's slowing, that is the message we're going to get from the Fed. In the meantime, the Treasury is auctioning a lot of paper and will continue to auction a lot of paper. And I think that could be problematic for the longer end of the Treasury curve. So I'm kind of like, all right, I'm stepping back now. Yeah. Do I still think there's a shot at 115, 117? Yes, because I do think inflation won't reaccelerate. There's people, it's going to go back above 4. I don't know, unless you get oil prices really ramping. I don't think so. And I do think the economy is going to slow meaningfully within the next 3 to 6 months max. That is going to be a big tailwind. So to me, it's just a question of, all right, let's see how much weakness shows up in the next week or two before, for me at least, being able to have confidence that, all right, this is what I think is going to happen next.
So Jim, I want to ask you this because since we're talking about TLT and we're talking about the bond market, positioning is. I've heard a lot of people talk about positioning has been extremely bearish for bonds. Yep. A lot of the hedge fund community is short the bond market. But at what point do yields become attractive? To where you're like, I think I want to take the yield on a treasury versus exposure in the equity markets. Are we there yet, or are we getting there yet?
Well, again, I think there could be a little bit of a selling wave here in treasuries over the next 2 to 4 weeks or so. It just broke this trend line. Maybe by next week we'll be talking and we'll be back above that trend line. Okay, that's a false breakdown. But I just think that until we see more definitive signs that the economy is slowing, I think that keeps people, from being too aggressive in terms of, hey, it's an attractive yield, I'm going to buy it, because no one is convinced that the Fed is really done. And in the meantime, upward pressure on rates is the course that they've, plotted.
Right.
So I just think it's coming. I still think there's a rally that will get back to that 110 high. My guess is that if the economy weakens as much as I think, that sometime by early next year, we're going to see TLT above 110. It's just how much weakness might we see in the very short term. Obviously, to the extent that treasury yields work their way higher, I think that's a problem for the stock market. Last year, what we saw is the Fed ramped rates up and treasury yields went up. PEs on the high, the mega cap stocks, which have high PEs, were compressed. We saw an inkling of that yesterday as yields popped. The high tech stocks, had a wave of selling. The volume on the NASDAQ was about 20 to 25% heavier yesterday than the average going back several weeks. So, there was some urgency of people selling yesterday in response. So I just think that if we see yields press higher, I can't help but think that the mega cap stocks, which have been carrying the weight in the equity market, won't see another renewed pressure. And, the hopes by the bulls is that the economy is going to avoid a recession, so it's the right time to buy cyclical stocks. Well, again, I have a problem with that in the sense that I think we're going to see the economy slow, which will neutralize that argument. All right.
Well, let's say I wanted to just shift us over to equity since we're starting to get there. 2 weeks ago, the last time we met, we were let me looking at your chart here. We were right around here. And I want to say right around, oh, where are we? I guess.
No, it would have been 2 weeks ago, buddy. So I think we're like 43.50-ish.
Oh, okay, somewhere
Yeah,
right here.
I
And I
think.
think we asked the question, is
Yeah.
this the high? Are we at the highs yet? And we basically brushed back up towards those highs. And
Yep.
in my view, we're still look like we're
Yeah,
we're
the
bullish
trend,
here. So
the uptrend is intact. Now,
yeah.
I in this week's weekly technical review, what I showed was that on that rebound to 44.58, the S&P recorded a higher close than it did at the 44.48. These I always use intraday numbers. If you want to measure the length of moves, you got to use intraday numbers. RSI uses closing numbers. So there was a huge, fairly large non-confirmation between the RSI last week as the S&P pushed up towards the 44.58 relative to the 44.48. On the NASDAQ 100, it was even bigger. So to me, it's like, all right, unless this thing really, really takes off, again, evidence is accumulating, at least from my perspective, that the market is running out of steam here. The key will be, how much strength gets generated by the CPI next week. I don't know. I think there's this chance you could see the S&P rally up towards 4,500, plus or minus a little bit. But again, my take and has been that a pullback is coming, and obviously I'm longer term. I'm more in the bearish camp. That I think there's another leg down coming in the S&P because the economy is going to slow. Even if I was bullish, like, okay, new bull market has begun. And maybe next week we'll look at the advanced decline line, comparing 2003, 2009, 2020 to what we've seen since last October. But even if I was a big bull, like, I would be like, okay, typically when you break out of a number like 4,200 was resistance for a while, important,
Big.
a pullback toward that. So to me, that implies a pullback toward 4,250. 4,200 will happen before you would begin the next leg up. That's my operating. And then we'll see, hey, if indeed that pullback develops, we'll see if it holds.
Well, it's going to be interesting. Next week's going to be a big one, Jim, especially with CPI. And I guess like a slightly weaker print showing that disinflationary pressures are still present. Will be the catalyst that drives us to potentially above to new highs for the week.
Maybe on this recovery. Maybe. Yeah. And again, Blake, people keep talking about inflation coming down dramatically. Yeah, the CPI has gone from 9 to 4, may hit 3. But, the Fed looks at core PCE. And that's down, I think, over the last year by 1/10, from 4.7 last June to 4.6, the most recent data for end of May. So, or maybe it was from June. I can't remember. My point is, that's what they're looking for in terms of having confidence.
Yeah.
That, hey, we're on the path for our number to get closer to 2.5. And there's nothing that would give them that confidence until they start to see more weakness.
Well, Jim, I'll tell you, it's always fun meeting with you each and every week. And getting an opportunity to, go through the technicals and the macro. I love how you do that. I for me as a trader, and this is how I've been for the last, quarter century, is I try to, have some sort of idea of what I think is going to happen, and then use my technicals to find those fine tune an entry point or trade around that theme. Yep. And I think you do that really well for the trading community.
Well, thanks.
And you do it great from a macro point of view, really digging into the data and having the reasoning why you should be long or short, whatever asset class. So I urge everybody at home that's watching this, make sure you reach out to Jim. How do I get that current issue of Macro Tides, Jim?
Send me an email, Jim Welsh Macro @gmail, and I'll send it to you. I really did a deep dive in terms of looking at, if you will, the labor market in great detail and why we're on the cusp of seeing that slow down. And as I mentioned earlier, gross domestic income. It's important. And it's interesting. everybody went nuts last summer. Oh, we got 2 quarters of negative GDP. Oh, the sky's falling. We're in a recession. Well, guess what? Gross domestic income didn't decline last year 2 quarters in a row. It was up in the first quarter, down slightly in the second, up big in the third quarter, but it has declined, as I mentioned, the fourth and first quarter of this year. It's crickets. No one's paying attention to those kinds of data points. So I appreciate your nice comments. I really try to look at the details because so many people just don't do it. It's like they see a headline. That's all I need to know. So when you get to inflection points, one has to go down into the data more in a detailed fashion to see when things are starting to tip. And that's I love doing it, and love the opportunity you and I have every Friday to kind of go through that.
Yeah.
Hopefully, it's beneficial, obviously, for those who tune in.
And maybe one of these days soon, Jim, you can give our Traders Summit viewers a nice discount to the macro tides, and we can talk about that in a future episode.
I give them 20%.
Wow.
So if somebody says, "Hey, Jim, I'm interested," well, if you're listening to Blake and I every Friday, 20% discount. So
there's your
I'm glad you brought it up. I hadn't mentioned that, gosh knows, forever. Maybe.
I'm glad you did. All right, Jim. Well, hey, I'll look forward to our conversation next week. And I hope you have a great weekend.
You too, Blake. Thank you.
All right, take care. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.